All right. Good afternoon, ladies and gentlemen. I hope you had a good lunch today earlier. My name is Vanessa Hayes. I am a portfolio manager and trader for the currency management business at State Street. First of all, let's have our panelists introduce themselves. Maybe start from you.
Hi, Llew Jury, Managing Partner and Executive Chairman now of Sprint Ventures. We're a VC fund based in Brisbane with 2 funds, and we'll be raising a 3rd fund this year. We have a lot of family offices investing in our business, and we have 20 portfolio companies.
Hi everyone, Daniel Nielson from Marshall Investments. We're a Sydney-based private investment office investing across a broad range of asset classes. We also run a co-investment model for some of our private credit investment strategies.
Hayden Matthews, thanks for having us. I'm the CEO of Volans. Volans is the new challenger bank in Australia. We're a digital private bank that just looks after family offices and the wealth management community.
I'm Alex Retzlaff, Managing Partner of Unify Ventures. We are a fund of funds. Effectively, we're backing 4 other fund managers. And the genesis, though, is from a family office context. So 3 family offices that got together and want to do investments in a better way in venture capital specifically.
Good afternoon, everyone. Tim Manson. I have my own family office based out of the United States called TKM Holding Company. Worked initially for my family company for 12 years in real estate development, design and construction. And then when I moved over there 12 years ago, created my own family office. We focus on all things real estate and bespoke group you'll hear about a bit later. Thank you.
Very much appreciate it. All right, let's start the panel by each of you. Can you give our audience one word that you describe the trend for this year? If you have a family office, what you would like to focus on, or if you're a VC, what you think family office should focus on. Maybe Llew, start with you again.
Start mine. Yeah, AI. I'll give some context. AI is very hot right now. Family offices, VCs, high net worths, wholesale investors, we're all in the room together. There's a lot of buzz around. There's a lot of buzz around where do I invest, how do I get into it. Every day we see the top line $200 trillion companies like NVIDIA in the public markets. They're setting the agendas down in our world of private markets and where's the next hottest opportunity. One sort of small piece about AI is a lot of AI that we see isn't actually AI. It's algorithms that are sort of 20 years old. And it's not true AI. And so if you ever look at an AI investment, make sure you get it checked by someone that understands true machine learning, generative AI, and all the fundamentals behind it.
Credit is what I'll say. I'm a bit biased because it's obviously something, a focus area of mine within Marshall Investments. But it certainly is an asset class in vogue, and I think this year it's going to continue to be popular.
I'm going to say geopolitics. That's what I'm probably most concerned about. It controls inflation, it controls everything. We could say Trump-Biden if we're using 2 words, but yeah, geopolitics.
I would say liquidity, as well as backing other fund managers and all that. The other thing that we're really interested in solving is some of the what we believe to be somewhat of the Achilles heel of venture capital funds, being such a long-ended vehicles of 10 plus years at times. And so we're quite interested in the whole topic around liquidity. And of course, with the Canva secondary and likely exit and all that, we're hoping that some of that will get recycled back in and so on. So the whole subject is very interesting to us.
I'm going to say 2. One is momentum. And what I mean by that is, especially after the last few years, there's a ton of negativity. So the companies that have really gained momentum through the last 6-12 months are the ones we really look at, and especially with real estate projects, they can weather the storms and pick out the momentum side. You can clearly see the winners. And the other word I'd say, and specifically real estate, is experiential. People want experiential real estate these days, not just the space.
Very much appreciated. Again, we have a pretty large panel today, so hopefully you can fit in 4 hours of content for the next 25 minutes. So among all the trends you guys just mentioned there, I do want to dive into 2 points. The first one is private credit. So we had a panel last year, 6 months ago. Everybody talk about real estate. You know, we're in Australia. We continue to talk about real estate, but certainly private credit has become a very attractive sector. Based on a survey end of last year of North America family offices, it's the first time the private investment exceeded the public equity. So Dan, can you talk a little bit more on that front?
Yeah, sure. I mean, at Marshall Investments, we've been, pretty invested in this asset class over a number of years, and we like it for a number of reasons. The yield obviously can generate and get paid on the way, and plus some of that downside protection through security. And so it continues to be a popular asset class for those reasons. And in this sort of market environment, with interest rates where they are, you do have an instrument which can, increase in line with those interest rates through floating rate mechanisms or repricing, and so that's where it's quite attractive. At Marshall Investments, we actually run a couple of our own credit strategies where we're originating, executing, and then and running a co-investment model where other investors sort of come alongside our structures, and that yield element and that sort of protection is quite sort of powerful in this sort of market. And I think when you can generate sort of anywhere from high single digits up to 20%, depending where you want to play in the capital stack and your risk tolerance, there's quite attractive returns there, and I think it's going to continue to be popular into this year.
Great, and then part of the reasons why private credit have a very high return, some are real estate backed. So I have to turn to Tim. You moved to California, is it 12 years ago? You're California?
12 years ago, yeah.
I'm sure a lot of audience here have real estate investment. Obviously, you're a little bit different. I think you're investing in some casinos at the hotel in Vegas. Can you please share a little bit more about your experience? And I think more importantly, how do we diversify into maybe different countries or different sectors?
Yeah, sure. So for 12 years leading up to that, I come through construction and development. We have a family development company here that's been building for over 60 years, based out of Cogra. And so I ran that business for 12 years. And after the GFC, things were very difficult in terms of trying to get projects backed. So we had very good design and construction division and sales and leasing, but I was actually getting bored with development because it was just too hard to get finance. So I decided to try my luck with some technology, with a technology company, a prop tech company, and ended up moving to San Francisco and focusing on that. And that was sort of the first diversification into technology. And then it evolved over those times. I sold out of that business in 2018, and then found myself 2.5 years ago. My wife and I moved to Las Vegas. She works with the Las Vegas Raiders, the football team. And so I had known a fair few people there and had invested in a project there called the Dream Hotel and Casino at the south end of the Strip. And lo and behold, a couple of years later, I've now partnered up with that same group. And we're doing several projects up and down the Strip in the casino space. But again, it's the same principles with development that apply. Our culture here in Australia is very similar to the United States. So the same things, whether it starts here or in the US, it's inevitable that things, come and go from there. So it's not, for me, it didn't feel like moving to a different country. It's just feeling like a different state.
Great, and you mentioned there's interesting space so you can store the wine under the ocean. There's a separate, different investment.
Yeah, that was one that was more out of interest than anything. But we were approached 5 or 6 years ago by a company called Ocean Fathoms. They're based out of Santa Barbara in California. And I got along very well with their team. They were sort of struggling a little bit to figure out how to work this wasn't a new idea. It was basically what they're doing is sinking 1,000 bottles of red wine at a time, 70 feet under the ocean. And it has 6 different scientific methods that speed age the wine. And it's something that's been going on in Europe for hundreds of years, but it's never been scaled. So we looked at it a different approach. They were trying to not only produce the wine, bottle it, put it down, bring it up, label it, and then compete with all the big names, which was just, to me, just completely stupid. The best way forward was I saw it as a storage business, or we saw it as a storage business. It's cellaring, so it's no different if you're storing at a self-storage centre or in a wine cellar. It just happens to be 70 feet under the ocean, and so we took a different approach and created a spin-off of that called Tidal Cellars, which now operates out of Santa Barbara and also a place called Coos Bay out of Oregon.
So that's interesting. Hopefully we can get some of that here in Australia and have some great wine for...
I believe there's a company here that started to do it. Sure. I saw it on the news a couple of days ago, yeah.
It's great. Definitely, looking forward to check it out. Let's move on to VC, right? Llew, the past 2 years has been somewhat challenging for VC, and as a family office, a lot of family offices obviously have private investment. What are some of the common mistakes you're seeing the family office making when working with VC?
I think the key thing is relationships. It's two-way relationships as an LP, a limited partner. Generally, family offices will invest in venture as a key stakeholder. Not every VC in Australia is like Blackbird, Square Peg, Airtree, and can have HCF and institutional super funds who are underwriting to the tune of $500 million, in terms of that. So a lot like us and Folklore and Rampazan and all the others basically require, the contribution and relationship of a family office. And we're lucky to have a number that basically have been really good to us, and it's been about communication. It's the good old thing that works really well in Australia. How do you build a great relationship? You communicate with each other, and that goes both ways. One thing I did observe over the last few years was family offices changed tact a bit. They still, generally the good ones, diversified into portfolios that had, like us in our first fund, 15 companies, and we've got 7 companies so far, aiming for 12 in our second growth fund. And what happened in sort of 2020, 2021, a number of family offices still supported us, but they also tried to do a market risk play and systematic risk play where they went and trying to do the deal-by-deal sort of stuff. They might have tried to employ a young person to be their VC arm, and then they sort of sent them out to go and find deals. And what we're seeing now in 2024 is maybe, a bit of that realization is happening that there hasn't been great returns, and Generation 1 is sort of, asking the question about, how well those investments, deal by deal, were actually, from a DD point of view, due diligence point of view, carried out. And when the going gets tough, these sort of things rise. And my message there is stick with the strategy around 2 things. One is patient capital, venture in our space. We wear T-shirts, not suits. So sort of in our T-shirt wearing space, it's a 10 to 12 up to 15-year play. You've seen the Airtrees and the Square Pegs and the Blackbirds extend their funds recently over the last 6 months. That's because in cycles, we need to sometimes extend them out. It's very different to private equity where in a family office, Gen 1 or Gen 2, like the mother or father might sort of say, look, I can do a 3-year swap on this great property deal or this, this real estate deal or whatever it is, and I can get a coupon of 9% as well, and why isn't my VC investment returning after 3 years? This is a 7 to 10 year plus patient capital play. And so the second piece is about portfolio and risk and making sure that if you're a family office, 2024 and beyond, you actually invest in a portfolio, because this is high risk. This is a high risk asset class. Many fail. Even though we invest in 1 in 100 that we see, we know that a number are actually going to be sunsetted.
That's great. We say the top 3 rules of family office investment is don't lose money, don't lose money, don't lose money. That goes for everything.
So easy.
And especially for family offices, the focus on the wealth preservation, right? So it's important to look at the right investment to try to avoid the mistakes. Alex, or anything you want?
Yeah. Okay. So we began in that way, like I mentioned earlier, with 3 family offices. So for us, ensuring that we have a good framework for co-investment, So we specifically, as we drop very big checks, oftentimes the largest checks into these emerging fund managers, and so but we set up all the site letters and so on, the framework that enables them to work really hard to enable co-investments for us. And then if you're going to go down that route, then not making too small a portfolio and truly look at portfolio management if you're going to take that route. And in our case, in Unify, we specifically, the next stage for us is to set up what we call the Opportunities Fund, which is to leverage those opportunities. So we make those large investments, we have the relationships, we have the frameworks in place. And what we ask our fund managers that we backed, for example, as a framework again, is we don't want to know how your whole portfolio is going. That's your job. That's why we handed $1 to $2 million to each of those funds. But we want to know like the top 3, and we want to get to know the founder and so on. So it's a bit of that investment that we are making through the fund manager, still letting them lead the deals, still letting them be the fund manager and the custodians of all that, but effectively having that relationship. So when it comes to things like bridge rounds that don't even go to market, then those are great opportunities to co-invest into what we call the top performers. And so for us, across 4 funds, for example, it just means that we have to keep a pulse on 12 potential investments to come in the future. That's a lot more manageable than say a portfolio that we have at the moment, which is about 100 to 120 startups. Yeah, so that's a better way to play it. Long term, I completely agree. I think it's the wrong way to look at it in terms of a short term outlook. It's got to be a long term outlook only. Some of it is also, I think, for the 3 families that sort of began Unify, we believe that there was other easier ways to make money. Fundamentally, we didn't want that to be the criteria. It's like we believe in venture capital. It's a bit like angel investing. There's a belief and where things begin. So sure enough, we don't want to lose our capital. So I agree with don't lose the capital, preserve capital. That's true. But so the returns have to be there. But it also begins with belief and an intent to back the things that commence sometimes entire industries. So it's yeah.
This is great. I always say investment is meant to be boring. If it sounds too good, it's probably not a good idea. Hayden, anything from you? I think you work with a lot of...
Yeah, I mean, we're probably on the other side of it. With managing family office money, we see a lot of these families owning different VCs, and it's sitting down with them and explaining to them, whether it's venture capital or whether it's alternative investments, why on earth you're owning it to start with, right? And you can talk to the institutional players and they'll typically say, because you're trying to reduce the volatility in your portfolio. So if you look at venture capital as an asset class, it's traditionally it's been an inflation hedge, right? So if you look at what's going on at the moment, it's a good time. So from our perspective, managing different families, I would say understand what the asset class does, where it sits in your portfolio, and ultimately what you should be trying to do, without giving financial advice, is get risk-adjusted returns. And what I mean by that is smooth those returns. We all love the wins, we all hate the losses, right? So it's smoothing returns and you get a balanced portfolio when you use it in the right way.
Appreciate it. Dan, any thought from you?
I agree with the sentiment up here. I think family offices are being a bit more disciplined in their approach and using the professional managers in those areas where they don't necessarily have the hands and legs to really cover it and do the sort of proper diligence. So I think there's definitely a trend to using those managers and then sort of investing on the side through that co-investment model, which works quite nicely when you want support from them for their network or their expertise in certain areas or certain sectors where that family office has made their money from.
Agree. I like the inflation talk Hayden mentioned. We want to hedge the risk, right? As a portfolio manager for currency, as Aussie is a commodity currency that we wanted to hedge that. So we'll come back to that point. But before we go into that, I do want to, we have a lot of startups in the audience. Some try to raise money. Any advice for them? And more importantly, as a VC, as a startup, how to exit?
I can probably talk generically in my sleeve. Sitting next to me is Daniel. We know each other from the VC community or in the investment community that we hang out. There's about 120 roughly that are in our group called Innovation Bay Aurora. And Daniel and his group with Marshall are in a completely different area to us. So the first point that I'd like to make is get to know what stage and cycle you're at in terms of your startup, and also what requirements you need for the capital and whether actually you need any capital at all. If you can do without capital, this is coming from a VC, don't take the capital. If you can try and bootstrap it through. We invest a bit later than everybody thinks. That's probably another thing. And then when you actually need some working capital and you need some other, a debt note or a covenant over that, Daniel and the family offices and others can come in and help out. Nick from One Ventures and the like. So basically, there's different forms of capital. That's the first point. The second thing is just a general comment about what's going on with the state of VC at the moment. There's been sort of some negativity in the mainstream press. And a couple of days ago, there was an article by Nick Bonahandy on this. And I to an extent, I agree with him. In terms of what's going on in the markets, there's a bit of sitting on the hands from the VCs. And as I said, VCs are no longer really angel investors. They're not early stage investors. That's more the high net worths, some of the family offices coming in with those smaller checks. And VC seems to have gone up the food chain in terms of their risk profile. The reason is we're also beholden to our LPs, and we've got to produce a return for them. And the LPs who are on our LPAC, our advisory councils, also have rights to sort of express their opinions as well. So the message to the startups is basically, if a VC says no, it's probably not you, it's them. That's the first thing. And the second thing is it's because there's other things above them that are going on, and also about their funds and the politics of their ICs and all that sort of stuff that are happening at the moment. But keep trying and make sure your funnel is really wide and you've talked to hundreds of potential investors, because that's the best way to get through.
Any advice how to exit?
Yeah, exits this year are interesting. Look, IPOs are very quiet. There's not a lot of liquidity that's going into those public markets. We're waiting for recycled capital back into the markets, and hopefully they stimulate that sort of more private equity buyout of the positions that we've taken in those early checks over the last few years. So be patient for the exits at the moment. They will come. We see it being a couple of years before there's going to be any true major exits in the Australian market. But they will come. It's all about cycles.
100% agree. Alex?
Yeah, I think what is spot on. I think so. In terms of reaching to family offices and all, is the alignment. So family offices are more flexible than VCs. VCs will have a thesis, a mandate, and so on. In general, let's be fair, they're in the business of saying no. So they're probably saying yes to about 1% of what they see. Sometimes worse, sometimes easier, but so it is that consideration. So I agree, go wide, but at the same time be targeted. So go wide in your research, then be targeted in your outreach, and then where with family offices, you think about it, you got to protect business. Well, who would you from this panel, who would you approach for a prop-tech play, right? So that sort of thing, right? So be targeted in that sort of thing, in that sense. So sounds obvious enough, but all too often, and I think the reason why VCs have to say no so often is because of the lack of that. They get way too much deal flow. That is not necessarily vetted, and that's okay. We don't want to put barriers to the deal flow necessarily. We want to have an open door policy, but that's a bit of a two-way street.
Yeah, I'll just add to that a little bit. I agree with everything. So early on, it's people. They're backing you. They're not backing your plan, your business. That's going to go wrong. That's going to not go the way you planned it. They're backing you. So if you like each other, it's like a relationship when you start dating. If you like each other, that's who you go with. If you've got a bad feeling with them, a gut feeling, don't go with them. Don't take their money, because it'll end up being a big mistake. To unwind it is a lot harder than to get into bed. So it comes back to what Llew said earlier. It's relationships, but really people, and only take. It's a hard thing to do, because when you need money, you're sort of, I landed this, but you've got to learn to say no as well, and learn, okay, is this the right person to get in bed with in terms of investment? Are they going to ride out some big days, not only the good days, but you're going to have the worst days of your life for a few years getting these things going. It's if they can ride that out with you, that's the perfect partner.
Thanks. Let's dive into the global horizon. That's why I mentioned earlier about hedging. Obviously, as Llew mentioned, we're in this inflation cycle right now, and one of the best ways is to diversify your portfolio. So let me maybe start with Hayden. In terms of the global horizon, we know Emergence, the conference expanding to Singapore, London as well. From a family office angle, are you seeing that we have a more increase of family offices, maybe come from Southeast Asia, China? Any trends you're
Yeah, I'm not sure if people have been driving in Sydney traffic recently, but you'll see if it's increased. It sounds like it's worse in Melbourne. There's so much money coming this way, it's scary. I'm not particularly a fan of it. I love family offices coming to Australia because I get clients, that's great. But I don't know if a lot of the cities that we have the actual infrastructure and things we need to support the population growth. And I'd like my kids to be able to buy a house. At the moment, it's completely prohibitive. And working, this may depress a few people in the room, but in this environment, typically what a family office is doing is they're predatory lenders, right? So they're running first mortgages books. We've all played Monopoly when we're kids. That's what they're doing now. They're buying this street, they're buying that street, and they're squeezing people. So I'd like to see less of that. Love them as a client, obviously, but I'd like to see more controls in place.
Certainly. In terms of the deal flow, investment opportunity, we have on the equity side, we have seen Japan equity have been going up. In Asia, India's economy have been going strong. Any thought in terms of deal flow, any investment opportunity, including maybe America, real estate? Anyone have any thought on that?
Sorry, what was the question?
Just in terms of global horizon of investment opportunity.
Well, I can speak to real estate specifically in the United States. There's a lot of hot spots and there's a lot of dead spots. It's very segmented, as you probably see in the news here. So Nevada, Las Vegas is booming with all the sports coming into town. It's really diversified into its own city now, not just based around gaming. Texas, Dallas, Austin, Nashville, Florida, Miami's basically people have started saying it's the new Los Angeles. So that's where all the money's going. From a real estate asset point of view, industrial obviously has just been through a huge upswing with the distribution, the last mile distribution side. We just finished 2.2 million square feet in Arizona, and that's fully leased, ready to go. Half it's to Amazon. But our focus now is on more of the experiential side, as I said earlier, with the hotel casino side in Vegas, and then also some automotive theme projects across the country that you'll hear about, the bespoke stuff. So it's the landscape's changed a lot with real estate. You can't just whip up a block of apartments anymore and expect someone to move in there. It's very different.
Yeah, thanks. We don't have too much time left before we end this panel. Can you tell us maybe something that keeps you awake at night, if you're comfortable sharing with us?
My 3-year-old?
My new puppy. I'll kick off really quick. I suppose it's liquidity in terms of my next raise for my fund. I'm trying to avoid, as I said, the mainstream press and just not read the doomsday. They got to get eyeballs right and clickbait for what they say in their reporting. But I actually think it's going to be hard for startups to raise this year. It's going to be hard for VCs to raise money this year. I think we're all in. The ecosystem, we're all in, and the VCs are ready to support the startups, and it'd be great to see the family offices support the VCs as well.
Appreciate it, Dan.
Trump Biden again, sorry.
Yeah, go ahead, yeah.
Yeah, just Trump Biden. That's such a huge, yeah.
Right.
Really?
Yeah, I mean, look, I'll say the uncertainty, right? I think there's a lot of optimism this year, and I think things are trending up, but there's still a lot of uncertainty out there, and that's obviously going to dictate, asset allocation and people's sort of investment and where they're putting their money.
Yeah, so I think based on discussions and different groups from founders to family office to fund managers, they're probably expecting that things will reactivate a bit towards the second half of the year. So that's sort of the time frame. At the end of the day, the whole sort of engine stops, right? You can't stop it forever, right? So fund managers collect fees if they're deploying, and that is it's a whole sort of chain ultimately effect. So we can't stop that forever. And I think liquidity, that's definitely what keeps us awake at night. We're specifically trying to solve that. Okay, so it's not just as a concern of ours, but trying to solve it for fund managers and for ourselves and so on. So watch that space. We're hoping to come to market with something soon.
I'm sleeping fine. No, except for the 3 odd. Yeah, no. Honestly, I think there's too much emphasis with media these days, with turmoil of politics and what's going on. At the end of the day, you just got to go at it, and there's never going to be a perfect time, and you figure it out.
Appreciate it. I would just want to add a little bit of final thought. Investment is a long haul. I hope every one of you enjoy the journey as much as the destination. On that note, thanks our panelists, and thanks everyone. Cheers.